Good morning. The video you just watched was prepared in celebration for our 20th anniversary. We are so proud to have been part of building this community over the last 20 years and look forward to what the next 20 years have in store for all of us. Welcome to the 2016 West Michigan Economic and Commercial Real Estate Forecast Breakfast. This is our 16th annual event. My name is David Weiner, and I'm a principal at Colliers International, West Michigan. On behalf of Duke, who couldn't be here today, and all of Colliers, we're extremely pleased that you were able to join us this morning for this forecast. Again, this year, this event is presented by Colliers International and Seidman College of Business at Grand Valley State University. On behalf of Colliers, I'd like to thank Seidman College and GVSU for their active support and participation in this event. As in the past, this event is made possible by people and companies that sponsor and help underwrite this event. We want to say a special thank you this year to our lead sponsor, Fifth Third Bank. Fifth Third Bank stepped up and underwrote a significant portion of this event this year, and we are very thankful for their leadership in this event and in our community. Our exclusive media sponsor is the Grand Rapids Business Journal. The Grand Rapids Business Journal has been extremely beneficial to us in communicating the workings of the commercial real estate world week after week after week. It's the news that keeps us informed. This year, our innovator sponsors are Ashley Capital, and they are on the panel today, Byram and Fisk, First National Bank, H&I, Miller Johnson, and Sun Title. Our thinker sponsors, DJ's Landscape Management, Downtown Grand Rapids, Inc., they are also on the panel, Rockford Construction, who is on the panel, Sidecar Studios. One interesting point, the video that we opened up with was produced by Sidecar Studios, and they're doing really neat things like that. And West Michigan Community Bank. Our collaborator sponsors this year are Cohen Financial, Grand River Bank, Excel Engineering, First American Title. And First American Title, just to point out, was one of our original sponsors, and they have sponsored the event every year since for all 16 years. So we're very, very happy to have them part of the event. Franklin Partners, Independent Bank, Netterveld Engineering, and United Bank. Can we please take a moment to recognize all of our sponsors? We really appreciate all of you taking time out of your morning to join us. We hope that this is a thought-provoking forecast, and I promise you we will get you out of here on time. Would you please all join me in welcoming Dr. Diana Lawson. Diana is the Dean of Seidman College of Business. Diana brings extensive leadership business programs and a wealth of international practice to GVSU. Please join me in welcoming Dr. Lawson.
Thank you. Good morning, everyone. It's a little early. It's why I tripped coming up the stairs. It's great to be here, and I want to thank David and Colliers International for their continued partnership in the economic and real estate forecast. This has been a long partnership, and it is a great example of how partnerships reinforce the benefit of collaboration between academic institutions, in this case Seidman and Grand Valley State University, and the community, that enhances our collective economic understanding of the region, and it helps us to collectively and collaboratively move forward to sustain an even stronger economy. So I want to take, since I'm up here, I want to take a couple of minutes and I want to point out something that's in the Seidman Business Review. You all have this on your table, and the Colliers video is a perfect introduction to the article. The article is near the end of the book, and it's called Social Capital, Economic Diversity, and Civic Well-Being in Flint and Grand Rapids. I would encourage you to take a few minutes to read it, not right now, but after this, when you have time at lunch or some other time. The article is based on research that was done 60 or 70 years ago, the seminal work, that compared communities and cities and looked primarily at the growth and the strength of the cities based on the types of companies that were in those cities. Flint and Grand Rapids were not part of the original study, so the study that's being done by Michael DeWild and a faculty member, a professor from the University of Michigan, Gerald Davis, extends that study by looking at and comparing Flint and Grand Rapids. And as many of you know, Flint was, in its heyday, a very, very large, strong economy in Michigan because of GM. Grand Rapids, on the other hand, has grown as a result of having a wide diversity of businesses, small businesses that have grown to medium-sized businesses, some that have grown to very, very large companies. And so it looked at what the factors are that really make the difference. And I want to highlight just a few of those factors because I think it's really important to understand these and think about them as to why and how Grand Rapids and West Michigan has maintained such strong economic activity. So the first one that I'm going to look at is entrepreneurship. There is a very, very strong spirit of entrepreneurship and startups of businesses. If you look at large businesses like Amway or Steelcase or Herman Miller, how did they start? Where did they start? They started in somebody's basement, in somebody's garage. They started as small companies. But because of that entrepreneurial spirit and the focus on innovation, they have grown to become very, very strong and successful businesses. And you all know of many, many other businesses that are the same way. Another key factor is shared values. Shared values across the region, they are unwritten shared values that are demonstrated here by work ethic, by integrity, by optimism of the people of West Michigan. And just as important is the value of giving back in this community. Everybody works together to make sure that everybody will succeed. And that's been one of the key factors that has driven the growth and success of this region. So we have entrepreneurship, we have shared values. And another one is social capital, and I can see that just by looking out over this room. Social capital is the social connectedness. It's the informal ties we have to families, to friends, to civic organizations, to social organizations, and many other types of organizations. So think about it. When you have an initiative, whether it's a nonprofit, you're looking for somebody to be on a board, or you're looking for someone to be in your organization because you need to hire someone else. Think, where do you start to look first? You think back through who you know, who you think would fit, who you trust, who fits your values. And you go out and you reach out to them and you come together and you move forward to make that happen. Grand Valley State is a prime example of that. Grand Valley State started because a group of community leaders decided it was important to have a state university in Grand Rapids. They went to the state in the 50s, said, we need a state university. The state said, raise $1 million and we'll start one. They went out, raised $1 million, went back. Grand Rapids was born. Grand Valley was born. And that has continued to grow because of the community support and collaboration that we have with them. And Bill Seidman was the lead instigator of all of that. And then finally, the one that I think is very important because I work at Grand Valley, is access to universities. Most of the long-term successful regions around the country have access to one or more universities. And that's for a number of reasons. Talent is a huge issue today and will be for the next decade. And where does talent come from for future generations as we move forward in our organizations? It comes from universities and colleges. If you look at Grand Valley, for example, out of the last graduating class, 90% have jobs or are going on to higher education. Of those who have jobs, 86% are staying in Michigan. Of that 86% staying in Michigan, a large proportion of them stay in West Michigan. 40% of the students at Grand Valley come from the east side of the state, but 40% don't go back. We're trying to get them to, because some of them, because Detroit and that area needs talent just as much as we need talent. But what we do, what Hope College does, what Calvin does, what Aquinas, Davenport, all of the other institutions in our area, we educate young people to be the future leaders of our communities because we attract students who want to stay in Michigan. And so that collaboration, and the collaboration like this one with Colliers, becomes really, really important. And we are very, very honored and fortunate to have such a strong community that really does engage with our students, with our faculty, with our administrators, because it makes us all better. But I would really encourage you to take a look at this article because there are a number of other factors that we don't have time to talk about. It also talks about some of the challenges that we will face as the demographics of West Michigan changes, and talks about some of the things that we have to think about. The other articles are great. They also reinforce the collaboration we have and how we've been able to work together to impact the success of Grand Rapids and West Michigan. So now, you don't have to listen to me anymore. But now it's time for Dr. Paul Isley, the person that I think you really want to hear from, to come up. You all know Paul, so I don't really have to spend a heck of a lot of time introducing him, but I have to say he's an associate dean in my office, and he's a rock star. It's amazing what that brain can do, and you're really fortunate to get some of it. So Paul?
Okay, so it's my job now to help you understand where our economy is in and hopefully not leave you too depressed by the time we leave. So, let's see. Click. There we go. So we always start these, as my predecessor Harry Singh did, by starting with how we did last year. And in actuality, not too bad, except for the US GDP growth. So we'll start with the one I did the worst on, which was US GDP growth. We were looking for something around 3%, and it came in something around 2% when it's all said and done. We were on track the first half of the year, fell apart the second half of the year, and we can divide it into two pieces. Half of the percentage point I lost was through exports, and half of it was through industries who decided to invest less because they were worried about those exports. So I was a little bit more optimistic about Europe and China, and I was wrong. But good thing is my job is to be accurate about West Michigan, and I'm pretty accurate there. So if we look at U.S. employment growth, I was expecting about 2.5 million jobs. We got 2.5 million jobs. So I think that's a hit. And I was looking for 2.8 to 3.2% employment growth. We came in just a little bit north of that. So I'm actually pretty happy with that. And when I'm wrong, I'm always happy to be wrong on the bottom side. So, all right. So we start with the United States, and we look a little bit now at how the United States is changing and why we are now starting to hear people worry a little bit about things that maybe they shouldn't worry about quite yet. Okay? If we look at the employment growth, the important thing here is the orange line. The orange line is telling us how we're sort of changing in the United States, and you can see we're getting between 1.5 and 2% growth if you look at over an entire year. But now if we look over 3 months, it's falling off. So our second moment is telling us that over the course of the next year, we're going to see employment growth in the United States come in slower than it did last year. When that little blue line's above the orange line, we're happy. And you can see last year when I was here, it was. This year, it's below. All right? And part of that reason you can see here. This is how, or the components that have caused growth in the United States. And you can see, by and large, for the United States, the recession was 1/3 manufacturing and 2/3 services. But the expansion US-wide has been almost completely services. All right, there's a little bit of manufacturing in there, but for the United States, it's mostly services, the big gray bar, okay? But I want you to walk away from this a little bit because the consumers are in much better shape than you think they are, unless you stare at numbers as much as I do, all right? And here's 2 numbers I'd like to share with you. One is the median weekly wage here in the United States. We started keeping track of this in 1980. Last quarter, we reached a record level, adjusted for inflation. That means the middle worker in the United States is earning more every week than they have at any other point in time since 1980. That's probably something you don't hear from any single one of the presidential candidates. So make sure that you think about that as you're listening to them. The percentage of income that we need to spend to maintain our debt is at a record low. We've never had to spend so little to maintain our debt. And you might say that's because interest rates are low. Our debt level has increased every single year since the Great Recession, all right? And actually during it as well. This means our consumers are cocked and ready, and they're the ones that are going to make 2016 work for us. All right, so if you're on the consumer side, you should be happy. All right? Interest rates. Interest rates are becoming nearly impossible to call because the big players here don't give us perfect data. All right, we know which way the Federal Reserve is going. We know that short-term interest rates are going to go up a little bit this year, probably less than what they suggested in their last meeting, but they're going to go up a little bit. The long term has been a paradox, and it's been a paradox because everybody in the rest of the world is saving in the United States, and it's keeping the long-term rates down. Think about this. China unleashed somewhere between, depending on which set of data you look at, $1/3 to $500 billion worth of US dollars in the last year. And it didn't budge our interest rates because somebody else bought it. That's good news. Everybody wants our debt right now. We'll see how that happens as the rest of the world heats up. All right? Government expenditures. I'm just sort of reminding you, our debt level to GDP has not increased really, but it's not going down. Where we're at right now is not a level that scares economists about today, but we are scared about the future because we haven't changed the mechanisms that will lead to debt 10 to 15 years from now. But it's not a short-term problem. And exports, you're going to hear this in the West Michigan section as well. Exports are just in a free fall, all right? This is the cost for you to hire a boat to carry dry goods across the ocean. And just look at how it's falling. It's just diving, all right? And it's doing that because nobody's trading goods. We're seeing international trade start to seize up because nobody wants to buy anything, all right? So as we look at next year, US-wide, we see consumers adding 2 to 2.5% to GDP. The problem is investment is only going to add a little bit, and net exports is going to take away all of it, all right? So in the end, we're going to end up in the low 2s. And that's about dead center on where the rest of the economists in the United States are polling out to. So that's the rest of the United States. The reason I'm here, however, I've given you this backdrop, and it's important to think about this backdrop because as you see this, and I start to walk through West Michigan and Michigan, you're going to see Michigan's in better shape than what the rest of the country is. All right? So, how's Michigan doing? I've given you the same graph. All right, remember gray is services, orange is production, and blue is government. So you can see our government has shrunk, which you didn't see US-wide. And you can see a big orange side here. So our recovery has been a manufacturing-led recovery. And it wasn't until 2014 that we started to see services take over. That gives our expansion a longer run than what we saw in the rest of the country, because that production is bringing dollars into West Michigan that we didn't spend, where the services generally push it around. Okay? So that's good news for us. But you'll notice that that blue line is below the orange line again. So we expect employment growth in Michigan to slow this year. All right? Notice it's still positive, but we expect it to slow. All right? And here's the reason why. I do this graph every single time I do one of these presentations, and it's really annoying to me that people in Michigan still don't realize that the majority of the job growth in Michigan was automotive, but the majority of job growth in Michigan was automotive. It still is. It's not changing. And you'll notice that we've reached a point where you shouldn't expect growth to continue. I said it last year. We got a little bit more growth out of the year. We're now seeing a lot of signs where it's going to start to tick down here as we head into next year, but not a lot. All right? It's going to be mostly flat. So that's good news for us. That's a strong base to build off of and to spread money around from the services side. All right? I also sort of like this one. This is mortgage debt that's 90 days late. So if you go prior to 2008, you could see the problems in Michigan real estate already starting to happen. All right? But look at where we've been since that time. We had the problem early. We're now doing much better than the rest of the country. All right? We're not seeing the same types of defaults. We're not seeing the same types of debt collection that has to happen in the rest of the United States. Good news for Michigan. All right? And on top of that, our bankruptcies are down. That big spike in the middle, oh, no, we don't have that there. Good. We cut it out. You can see bankruptcies are down, and they're down to where we would expect them to be during good times. So all of this means the Michigan consumer's not under stress. They're not getting late on their work. They're not having to declare bankruptcy, and they have a job, which is a good thing. If Michigan's doing better than the U.S., West Michigan is doing better than Michigan. Except for maybe downtown Detroit, which is doing pretty good, but you got to be right downtown, inside the donut, before you get into trouble again. All right? So if we look at this, look at that. We've been running close to 4% growth, averaged over a year, for over a year now. That is just breakneck pace. We do not have workers to support that. If you look in West Michigan, unemployed workers in West Michigan have gone down by 4,000. We've added 4,000 people who are unemployed to the work rolls. But we've added 20,000 more jobs. To do that, we're drawing people in. We're seeing people in the 25 to 35-year-old set stay or come back or move here for the first time. All right? We're seeing that demographic start to grow, and that's influencing a lot of what we see downtown. And here you'll notice the blue line is above the orange line or right on the orange line. So we don't expect tons of change in these growth rates going forward. It'll slow a little. All right? And here you'll see, unlike Michigan that was mostly manufacturing, and unlike the United States that was mostly service, West Michigan started manufacturing, ended service as far as growth goes, but has had a good divide of both of them. And as Dean Lawson stated before me, the secret here is that diversified economy, all right? And that's what's been giving us the legs, all right? You'll notice government shrinking too, so I'm not sure it can shrink a lot more. It's already pretty tight. And if you look at government as a percentage of workers here in West Michigan, we're way below the national average. So we shouldn't be looking there much longer. All right? We show this line to reinforce the fact that we're moving away from manufacturing. This is the ISM index. It's done by Brian Long out of Grand Valley State University. There's lots of lines there. Look at the dotted line. You can see the manufacturing sales trend over the last 2 years is essentially downward, okay? We're still doing well. The last half of last year, however, was really ugly, all right? And that had to do with us peaking out on automotive, all right? So, housing markets, residential housing markets, because my Colliers cohorts will do a much better service to the commercial side of it, all right? The residential side, this is an important story, and I think it's one that you sort of have to get to, all right? Grand Rapids had a really bad housing crisis, all right? You could drive through Grand Rapids. It wasn't like Detroit, where all the houses were empty, but there were areas of Grand Rapids where you might have gotten confused as to whether you were in Detroit for a few years there, all right? We also saw a marked drop in housing values right here in Grand Rapids proper. The story, however, here is the difference between the darker line and the lighter line. The darker line has only non-distressed housing in it. The lighter line includes distressed and non-distressed housing. You'll notice that that housing bubble that we had coming into the last recession was mostly because of the distressed housing, that lower end of the market that got too high. And then the crash at the end was everybody bailing out of that lower end housing and it going really low. The housing crisis in Grand Rapids is done. And we can say that definitively because the two lines have converged. All right? We no longer have a distressed market which is influencing the overall price level in Grand Rapids. And if it's not happening in Grand Rapids, it's not happening in the rest of West Michigan. All right? If you go to the outskirts of Grand Rapids, to any market with a good school system or a nice lake, they're above their 2006 prices now. All right? So really great news there. I'm pretty happy about that. Means people stop asking me about housing, and it means that maybe it's time for Discovery TV to stop the shows about flipping houses, because it's not so easy anymore. All right, but here's the story. I'm showing you here for the Grand Rapids MSA, but we also have the Michigan, because this is as far as we can go for the Grand Rapids in data. We have Michigan up until November, and this trend continues down. So our percentage change in exports went negative last year, and that negativity is accelerating. Realize our growth that happened coming out of the Great Recession, exports were growing at 10 to 20% a year, and they're now going negative. That's a huge deal, okay? Come on, click. There we go. As a result, these two snaking lines are the West Michigan Confidence Index that was started in 1995 by my predecessor, Dr. Singh. All right. We've done it consistently. We've done it in a consistent manner. We've had consistent response rates. We do it at a consistent time of year. And you can see we were pretty happy in the 1990s. Who couldn't be happy in the 1990s? You know, Prince's song was right, and we were pretty happy, and we got to the end of the party, and it wasn't so nice. All right? And you can see here in Michigan, we dropped 20 points as we went through the first part of the 2000s, as we endured the first phase of the Michigan recession. And then when the rest of the United States went into recession in the last half of the 2000s, we got even more pessimistic. The good news is we are now just a smidge below how happy we were in the 1990s. And by who we are, these are the CEOs and presidents of the corporations around Michigan, all right, around West Michigan, out of Kent, Ottawa, Muskegon, and Allegan counties. This is their confidence in the economy. They're almost as confident as they were in the late 1990s. That's a huge deal. That's a huge turnaround. This year, it was flat from last year. So it had been building. This year, it was flat. And on almost every single measure, even though their confidence was the same as last year, they became more pessimistic. They're still pretty happy, but they're more pessimistic than they were last year. So the light line is last year, the dark line is this year. All right? So last year, notice that big spike in anticipated employment change at 2 to 3%. Notice that that goes away this year and starts to go down to the 0 to 2% range for the most part. So more firms are looking at that bottom part of the market as being where their employment growth is going to come from. If we look at their sales, last year they were expecting, a lot of them were expecting above 3%. This year they're talking 2%. All right? That's a big change. All right? And here, they haven't even caught up with the data. The average CEO in West Michigan still expects their exports to grow. And we already know that that isn't true as a group across West Michigan. It's already turned negative. They've pretty much got it. They went from expecting 15% growth 2 years ago to projecting 10% growth last year to expecting 5% growth this year. All right? It's dropped down considerably, just not enough yet. This is the number that's going to hold us back a bit this year, and that's the reason manufacturing is going to be weaker this year than we expected. All right? So let me do the quick overcap, and then let me talk about two things to think about as we go through this year. All right? Employment growth. Last year we were talking slightly above 3%. This year we're talking between 2.5% and 3%. All right? And there's higher risk right now for the lower part of that than for the upper part of that range. Okay? Sales growth, we expect that to tick down a little bit this year and move closer to 2%. And export growth, they're expecting between 2 and 4%. They're not going to get it. It's going to be negative. All right? The U.S. economy is continuing to expect it to grow, but it's going to slow as well. So the expectation is that the year as a whole is going to look a lot like this year. All right? So what are we looking at here? What's the stories and how can we take advantage of this? As we look at this coming year, one of the stories that was going to happen is the one that I was talking about early on, that median income growth, that median weekly income is increasing. It's increasing really, really fast. And it's going to accelerate as we go through this year. So 2 years ago, I told you you'd be spending less than $3 on gas by the end of the year. And I was correct. I got lucky on that one. But I decided to go out on a limb, and it worked. Last year, I told you you'd be paying your workers more by the end of 2015. And my bet is, if I asked for a show of hands, all of you are paying your workers more. All right? And probably you're worried about somebody poaching your best workers. This year, you're going to be paying them even more, and you're going to be looking at much larger raises for them as you go through this year. What does that do? That changes the dynamic. This is going to be a bad year for people who get income from their wealth. All right? So the richer you are, the more income you have coming from your wealth, you can still be pretty happy because you're rich, but you're not going to have as much income. All right? The bottom part, however, and the middle part in particular, is going to see their incomes sprint forward this year. So those of us who are reliant on our incomes to do things like buy houses and cars and furniture or buy services. My income had changed enough, my wife decided to have a dog masseuse this year. So my dog now gets massages. That's how you divide income around the world, okay? Don't tell my boss that, she'll cut my wages. So what's happening there? We're going to see that middle part of the market really start to percolate for us. So businesses that are attacking that middle part of the market are going to be much happier this year than they were last year. For people who are selling things overseas, people who are selling luxury goods, they're going to be less happy. All right? And people who are selling to poor people, well, the poor people are going to be doing better, but there's only so much growth that happens there. All right? So, but that's going to be good news for our governments because they're going to have less money to support that group of people. all right? So governments are going to be better off. They're going to have less stress on their stuff. Middle income is going to be happy. People selling to that group are going to be happy. Upper income is going to be less happy because they're going to be struggling to find the yields that they want, all right? So that's where we're heading for this year. Hopefully that's not too pessimistic. As I was talking to Mitch earlier, the story is good, not great. We're moving ahead, and it's not going to slow down this year. It's looking like we have a really decent year ahead of us for 16. And right now, the probability for a recession in 16 is really low. The probability for a recession builds every month after you get to about the middle of 17 through the beginning of 2000. So if you poll economists across the United States, their expectation is sometime between late 17 and early 2000, we'll see our next recession. The good news is we don't see any direct cause for the recession. So our last recession had a direct cause. The financial system melted down. Somebody threw a big rock in the pond and it created a big ripple, all right? If we don't have a direct cause of the next one, the next ripple is smaller. And the next one is smaller, and the next one is smaller. All right? So we should expect this next one to be smaller unless something new happens in the Middle East or China decides to melt down. And they aren't melting down right now. So good news for the year, not as good as last year. So every year I come to you, it gets a little worse. So don't tell Colliers, maybe they won't want me to come next year. And we will move on to the next part of the program, which should be the commercial real estate.
Well, good morning, and thank you, Dr. Isley, for that economic overview. So, I know you all are going to be fairly eager to hear what I have to say today, but in case you don't want to write everything down, all of this information is on the books on your tables in front of you, so please take those with you. We'll start today by going over the industrial market. That is my bread and butter and where I spend most of my time, and the backbone of the American economy, as Paul so cordially put. Last year we spoke quite a bit about how there was a lack of supply in the market and that was going to create a need for both speculative development as well as built-to-suit construction. We did finally see that towards the latter part of last year from a speculative construction standpoint. These are two examples of buildings that were put up both in the southeast submarket. Those are both approximately 50,000 square foot buildings that have all of the infrastructure to accommodate most all modern manufacturing today. On the build-to-suit front, we saw a number of companies go down the road of building customized buildings for themselves. These are two examples of companies in town here that are expanding and did want to proceed forward with new construction. Edo Magnetic is a company that is going to be building a 65,000 square foot plant out by the airport on 60th and Patterson on a 10-acre site there. And Weeke North America, who is going to be occupying about 50,000 square feet in 100,000 square feet, again, both in the southeast submarket. That attributes to about 50 million square feet of our entire market, which is about 115 million feet. So on the note of moving into more modern manufacturing plants, this is one of the last examples of older multi-story manufacturing buildings that are really more functionally obsolete for today's needs. So Display Pack is the company that was occupying this building for many, many years. They sold that building this year, or in 2015, and are in the process of vacating that, and that will likely get redeveloped into a multi-use that may include multifamily, office, and retail, and that is located off of North Monroe, so in the Central Business District area. From the investment perspective, industrial was a very hot and sought-after product type in our market. We're giving two examples of projects that have taken place in 2015. The first one that you see on the screen there, 5010 52nd Street, that is a cool story in that was the former corporate headquarters for Zondervan Book Publishers. That was bought a couple years ago by an investor that has much more of a redevelopment mindset. They ended up separating that building from the offices and the industrial, which left about 165,000 square foot industrial plant there that you see. That was leased out to Lax for one of their distribution components of their business, and then that was subsequently sold off to an investor, out-of-state institutional money that was looking for more stabilized cash flow. The second property that you see there at 5875 Weller Court, that was a building that was already a modern manufacturing building and was purely sold as an investment for stabilized cash flow. Again, out-of-state money coming into Grand Rapids. Industrial is a very sought-after product type because we have such great fundamentals here and there is a diversity of companies here. Switch, that is something that has made a splash in the news as of late. So many of you have heard of them coming to town, Nevada-based firm. They finally got the legislation that they needed passed in order to locate here. This is a huge win for West Michigan. They are going to be locating in the former Steelcase Pyramid. That pyramid is going to maintain its office use, but there will be some new development, as you see on the second photograph, for the industrial component of it. That is likely to have an effect on that area there. As that new employment base comes in there, there's going to be needs for other services that would affect both the office and retail market. As it sits right now, most of the land that is surrounding the pyramid is all zoned industrial, but we'll see how that transpires over 2016. The office market, much like industrial, there was a lack of supply of really good quality buildings today. There were some more functionally obsolete, dated type of buildings that were really not what the users were looking for today. So that was sparking a need for new development. This is one example of a project in the suburbs that's going up. This is at 2060 East Paris. This is the second phase of Heritage Point. That is going to have all the modern amenities that the users are looking for today. So things like fitness centers, nice common areas, polished finishes, and in the suburbs particularly, it's important to have a great parking ratio. There was also a desire to acquire buildings. For users that were tenants, they wanted to look at buying buildings. Downtown is really not conducive to a lot of that unless they were also looking to be a landlord. Most of the buildings in the downtown area are more the multi-tenant type of a scenario, and it's much harder to get into a scenario where you're occupying your own building. So we're giving you two examples of some transactions that took place this year. One is Compliance Systems at 1575 Arboretum, which is out off of Cascade Road there. They were actually a tenant in that building and then ended up acquiring that building in 2015. The second one is Applied Imaging at 5555 Glenwood Hills Parkway. Again, they were in the market for many years looking to buy a building that could accommodate both their office need as well as they had a strong warehousing component of it. This building services a little bit of that, but not entirely. So they likely will be having to find something new for their industrial component as well. But Downtown was extremely hot from a tenant base. We spoke last year a lot about new construction that was going to be happening. Arena Place was the most notable project. That will be coming online in 2016, and the cool thing about that is that it is almost 100% occupied. It is mixed use, mostly offices, and that is going to spark a need this year for some further development. So we'll likely see a new tower downtown again this year or get underway from a construction standpoint that will service the office industry. There's one that's been proposed now at the corner of Ottawa and Lyon that should be anchored by a local law firm, Warner Norcross and Judd. We also put the Michigan State University Research Center on here just to show the development downtown. This is not a building that's going to service the general office user that's looking to locate there, but it is a signal of a growing and healthy downtown area. From an amenity standpoint, this is also what's driving some of the downtown new developments. The tenants are really desiring modern looks and feels. You need to have fitness centers, you need to have common areas, and for those that like to locate downtown, they want the walkability to nightlife and restaurants, and they also want to be located close to some multifamily for the next generation of employment base that's coming in. So the millennials really like that whole walkability, live, work, eat environment. And so for some of the older buildings, those have to be renovated. We put 25 Ottawa up here as a good example of that. That was a building that was older and dated, and it needed to have updates put in there to attract what the tenants are looking for today. On that same note, tenants also looking for those amenities. They also want smaller workspaces that are more collaborative type settings. So what you see here is just two examples of kind of an open workspace, moving away from the trend of having closed off offices, going into more of the collaborative type of setting, a lot of natural light. And on that note, when these buildings do have to be renovated, the rate is not as much the driving force as it is the quality of the workspace. So the tenants, as of late, have been willing to pay a little bit more to have these amenities, to really hone in on attracting new talent and keeping them. Turnover rates want to be kept at a minimum, and so that's the idea behind having first-class workspaces. From the investment perspective, office was also a sought-after product type, more on the redevelopment side. These are two examples of buildings in the suburban area here. 5300 Patterson. This is the second component of the Zondervan building that we spoke about in the industrial section. So here are the offices. This is currently anchored by Kellogg's. There's approximately 30,000 square feet of space that's yet to be filled in that, and then once that does, that gets sold off to an investment group that is looking for stabilized cash flow, and that could be on a local or national basis as well. The Belfry Office Park, that was a transaction that took place in 2015 as well. Again, that was a dated office park. There's going to be significant capital that's going to be invested into that project in order to attract the tenants and meet the demands of what they are looking for today. So whether that gets spun as a stabilized cash flow after that gets absorbed in the market is yet to be known, but again, it's just an example of what some of the redevelopment investors are looking for today. Retail had a great year. Last year, we spoke a ton about Tanger Outlets. That was a big splash in the news that came to fruition in the mid part of 2015. That did not create a new retail corridor in the market, but it created a destination retail center that's about 95% occupied right now and has had a good effect on the surrounding businesses that are more service-based and industrial-based from their real estate value. The Village at Knapp's Crossing, that has been a project that's been underway for about 7 to 8 years. Many of you that have driven up on the Beltline have seen that there. You've had D&W Fresh Market that's there, and P.F. Chang's has come online. But finally this year there was some momentum behind some pre-leasing. There's new construction that's happening there. You've got Bravo, which is an Italian type restaurant there. Bagger Dave's is up. PNC Bank, amongst a few just to name, that are pre-signed or already occupying that center, and we will see more development going on there over the course of 2016. There was also a trend towards redevelopment. So last year we spoke a lot about Centerpoint Mall and the demalling of that to give a lot of those tenants exterior access for their customers to come in. That was a huge success, and subsequently we are now seeing that at the Shops at West Shore, which is a Holland-based mall that is under the process of being demalled right now and should hopefully have the same sort of an effect that it did on Centerpoint. This is just a list of some retailers that are currently active in the market. So active meaning they are searching for space. This is both on a local tenants as well as some nationals. Reinvention of urban retail. So getting back to the millennial generation that's really looking for that live and work environment and having everything in one place, there's been some development that's gearing towards that. Fulton Square is an example of having multifamily on the top 2 floors with retail on the ground floor. And then right down in the Central Business District, the Venue, which most people know the site of the Bob, that is under construction right now. That's going to be a multifamily tower that's there, and that will have retail on the ground floor, but will also expand on retail and really be more entertainment with an amphitheater and beer garden and a lot of things for the citizens and the tenants there to enjoy. The Gateway at Belknap, again, staying in the downtown area. This is up off of Belknap Hill. This is going to be a project, again, multifamily, top couple floors, retail ground floor. And this is over in the area that's going to really service Grand Valley State's campus that they have there, as well as Spectrum Health. So a cool project underway, lots of homes being demolished there to accommodate new construction. Easttown Flats is moving out of the Central Business District, but still an urban area. And again, living by the model of live and work and walkable to wherever your job might be in that particular area. But that project has been a great success, and we're seeing more of it, as you can see by some of the graphs we just spoke about. From the investment perspective, this chart is, or this picture is really to stipulate that you've got some projects going on in the core and that investors are also looking in the more suburban areas. The theme has really been on the development, so new construction, as well as some of the redevelopment. What we're seeing for 2016 is that the pipeline is pretty full. We're going to see a lot of these projects come to fruition, get absorbed in the market, stabilize, and then you may see some of the investors that are looking for more of the stabilized cash flow buy some of these properties. But as far as we see it for 2016, we're not going to see a whole lot of new projects come online until these really get absorbed into the market. So investment as a whole, we've touched on it with each subcategory. The market as a whole has been pretty healthy. This chart stipulates the U.S. Treasury versus cap rates. Cap rates is on the top red line there. You can see that's been relatively stable, and this is also a national average. This is not a West Michigan average. But you can see there that cap rates have remained relatively steady, and when the Treasury rate starts to go up, generally speaking, so do cap rates. So what we're anticipating for 2016 is that interest rates do rise a little bit. That may have some level of compression on cap rates, albeit not that dramatic. And that the nice thing about West Michigan, given the fundamentals that we have here, there's still going to be a large pool of investors that are looking to place capital here. So there's generally speaking a difference of about 50 to 200 basis points of a spread on cap rate from what you might find in a Chicago or Detroit or any sort of a tier 1 type of a market. So it's still a great place to invest, and investors are looking to place capital here if they can. So a recap as a whole, the market is healthy. It is going to remain a seller's market as inventory is relatively low across the board on category groups. Industrial, as we see it being continued to be the most sought after product type for investment, and inventory is going to be extremely low. So for those that have held assets for quite a while or stabilized them, this is going to be a fantastic year to move out of those and place capital in other areas if they so choose to do so. Residential. So to riddle a little bit about what Dr. Isley was saying, the market here has stabilized and done very well over the course of the last few years. This is a chart that it comes from the Grand Rapids Association of Real Estate. You can see there in the middle of 2007 and 8, there was a peak amount of listings on the market at just under 11,000. That number has dropped down to just over 2,600 today as an average. So that's an enormous drop in the number of houses that are currently on the market. Translating into number of homes sold, we're kind of right back at where we were when we saw it at the peak. You've got just over 13,000 homes sold on an average base in the Grand Rapids Association's area, which is a signal of a strong housing market here. That directly translates into exactly what Dr. Isley was saying as it relates to pricing. Our last peak was at about $165,000 for an average home price in the area, and that number has risen to about $175,000. So it's not showing any real signs of slowing down here in 2016, and we anticipate that to be the case going forward. So to recap, I think we would riddle exactly what Dr. Isley said. We are anticipating that 2016 is going to be a good year. I think we're going to see progress in some of the different product types, but we're not going to see a gangbuster year for any sort of new construction or things like that. Tenants that are active in the market are continuing to try to seek out the modern type of spaces across all product types. And overall, it will be healthy as people continue to move and want to live and work in Grand Rapids. So with that, thank you guys for your time. We appreciate you all being down here. I would say be bullish on Grand Rapids. It's a fantastic place to live and work, and thanks in part to all of you. So with that, I'll introduce Mike Murray, who is a partner of mine and is going to introduce our fantastic panel that we have here today to talk about the political environment as well as West Michigan and the east side of the state. So thank you.
Thank you, Matt. As Matt mentioned, I am Mike Murray. retail advisor and principal at Colliers International, West Michigan. I'm going to welcome up here our panel discussion, and I'm going to start by introducing them. Mitch Stapley is the Chief Investment Officer for Fifth Third Asset Management Group, wholly owned subsidiary of Fifth Third Bank, and he has over 28 years of investment experience. Dr. Paul Isley is going to come back up here to join us. He is the Associate Dean of the undergraduate program in budgets at the Seidman College of Business at Grand Valley State University. The Grand Rapids Mayor, Rosalind Bliss, is also going to be joining us. She became the City of Grand Rapids' first female mayor this past January 1st. So she's got plenty of experience over these past few weeks, and we're very excited to have her join us today. Chris Larson serves as the president and CEO of Downtown Grand Rapids, Inc., the organization charged with managing the continued revitalization of downtown Grand Rapids. Chris has over 13 years of experience facilitating downtown economic growth in cities such as Long Beach and Raleigh, North Carolina. Kurt Hasberger is chairman of the board and president of Rockford Development. He's held this position since 2011, since joining Rockford Construction in 1995 as their general counsel, and after 17 years of practicing law. Chris Brochure is a partner and owner of Lormack Stern Development Company, which has a national reputation for successful developments across the country and of repositioning many shopping centers. Chris has been involved in successful retail developments for over 30 years and has over 20 million square feet of developments completed. And Kevin Haig, Vice President of Ashley Capital, a privately held development company that specializes in value-add developments, and they currently have over 25 million square feet of inventory. I'd like to welcome you up to our stage, and we'll start our panel discussion. Thank you very much, Rosalind. Thank you, Paul. Thanks, man. We're going to wrap this up as close to 10 o'clock as possible because, as you can tell by this presentation so far today, we're all very active and busy, and through some of my discussions this morning, I know a lot of you have very busy days ahead of you. So I'm going to start today with a question to Chris Brochure, Kurt, and Kevin. We're seeing this trend of a lot of redevelopments happening of existing product. Is that a trend around West Michigan, or are you seeing that statewide?
Well, not only is it statewide, but it's national. Starting in 2008, when the world came to an end, everybody stopped constructing buildings. The cost of construction has gone up considerably since then. Major retailers have slowed down considerably on their expansion plans. And right now, everybody in our industry is focusing on redeveloping older malls, older shopping centers. There's a lot of Kmart buildings that are going to be coming available. There were a lot of department stores that have been available. You had CompUSA, Linens and Things, and Circuit City and various other retailers that have gone out and have created a lot of space available for a lot of the TJ Maxx's of the world and so on and so forth. So that's why you're seeing the redevelopments all across the country, not just in Michigan or in West Michigan.
Sure.
Yeah, on the on the industrial side, I would agree that it's not just a trend, it's more of a segment of the business. We specialize in it somewhat, and the opportunity kind of follows where the availability is and the demand is. So we do it on a national basis. What's been difficult for us of late is finding the availability. For a large portion of time prior to the recession, a lot of the opportunities have been picked over. The recession broke loose some additional opportunities, specifically in the form, for instance, the GM bankruptcy. We just recently purchased a GM facility in Livonia, Michigan. That's 1 million square feet. That was part of the old GM. So that spun off some opportunities for us. And as Chris was saying, a lot of it's driven because you can't develop new, so you go after, you can purchase for under replacement cost and hit the price point that the tenants need. And it's really just, it's always there in the background, and it's just a matter of whether the availability is there to take advantage of it.
We see it, we see it nationwide. I mean, we're in about 10 or 15 states at a time building, and we do see it everywhere. And I think it's happening for all the right reasons. I think there's environmental issues with it, where you have roads and infrastructure and power and everything else already there. Why not bring old buildings back to life? We've seen it in Grand Rapids very successfully, and it's what the millennials are looking for. It's what employees are looking for. I mean, there's some trends here that the redevelopment effort really fits into.
Sure. Okay. Mayor Bliss and Chris Larson, there's a lot of buzz out there with restoring the rapids and the Grand River right outside these doors. What's that going to do to real estate values in the downtown CBD area as well as the west side? And are there any other examples of communities across the country that are doing something so aggressive to bring a natural resource back to life?
First. I think it'll be amazing for downtown and for real estate. I think it'll be a catalyst for redevelopment all along the river. I think there's tremendous opportunity sites along the river for redevelopment. Just thinking about city property, we have a lot of property on the river that has long been underutilized or poorly utilized, and those are potential opportunities for redevelopment. So I think it'll be a catalyst for development along the river and in downtown. When you think about other cities, I'm biased, but I'd say no one is doing something as bold and amazing as Grand Rapids.
Sure.
This really is a tremendous opportunity, and I think it's a rare asset that you find in cities. If you look at the asset of the Grand River, from Ann to Wealthy, we have an 18-foot drop, and that creates this opportunity to restore the rapids, but also have it be this incredible asset in a number of ways. So when I think about other cities that are doing something as aggressive, I think cities throughout the country recognize the value of restoring their waterways and their riverfront. And so you're seeing that in Detroit and Chicago, and but I think our asset is really unique.
And I would just add to that it's really about creating a new type of value. The Grand River has long provided value to Grand Rapids. The city was built around it.
Mm-hmm.
But it's providing a new type of value, and I've heard the term millennials used a lot today, and it's funny how we talk about millennials. They're really the majority of the American workforce. In the next decade, they'll become 75% of the American workforce, and they're making different type of lifestyle choices and choosing to live close to where they work. It's a part of that generation's preferences. And that's really going to start to help to drive America's preferences. And so when we think about the river and the restoration of the river, it's more than just what happens in the river itself and the opportunity to recreate the rapids. It's really what happens alongside it and repurposing all that property to create that new environment where literally we're talking about a thread that can connect the community with a multimodal path that really ties it all together to create a different type of living environment that right now we believe is going to be a future type of competitive advantage for Grand Rapids in competing with those tier 1 cities. It becomes a different type of lifestyle amenity that's really difficult to recreate anywhere else.
Sure. Well, with that said, back to Mayor Bliss and Chris Larson again and Kurt. In Detroit, Alley Financial moved to their CBD to attract young talent and help that CBD flourish even more. Are we in a position are we ready to bring a corporate headquarters to our CBD, and what's it going to take to land a major employer?
It's already happening. And we saw a huge move last year with Spectrum, who's our largest employer in West Michigan, to make a very bold move to locate its IT professionals in the downtown, recognizing that it needed to be in downtown to be able to continue to retain and attract the talent that they're looking for to support that organization and that company, and to be able to recreate and really repurpose 25 Ottawa for that use. Obviously, that's a symbol, and it's by no means the end of it. It's just the beginning. I think we're going to continue to see that emphasis, at least on the creative side of companies choosing to make sure that they remain competitive on a national level.
Sure.
Well, and I would just add to that, and Chris alluded to this in the earlier question, that it is about place. So, I see, attracting additional companies and especially to want to be downtown. It's about having a great city It's about being a place where people want to be, where millennials want to be. But it's not just about downtown. We also need to have really incredible neighborhoods and recognize that there's a synergy. We want people to have choices on where to live, and they may choose to live downtown, but they may choose to live in one of our great neighborhoods. And so as a city, we need to make sure that we're an attractive place where people want to come and live and raise their family, and that will help attract the talent that's needed for the workforce.
Sure.
And I think depending on how you define the CBD, I mean, we at Rockford Construction have already done it. We've been in our corporate headquarters on the Near West Side now for about 2.5 years, and it's been an incredible success in terms of recruiting the talent you see at the table over here. It's really worked out for us great. So I think we're sort of I'm not going to say pioneer, but a little bit of a poster child for that. And I guess I'd make a couple other points. I think to some extent, this may be a little bit generational. We've dealt with a lot of companies over the last few years where the leadership of the company are people my age. They can't quite wrap their head around moving their company downtown, and their kids work in the company, and they're pushing them in that direction. Well, it's not going to be long before those kids, I call them kids, are actually running the company, and they're going to be a lot more open to that kind of idea. And I think the other thing is it's like anything else. It has to be in their best interest to do it. And I think that's going to start to happen as we continue to make the downtown cooler and cooler and cooler. People are going to see that they have to do it. That's where their employees want to be. They really don't have a choice. And sooner or later, they're going to have to come downtown or start losing talent to people that are there. So I think it's almost an inevitability, and I think it's a long-term trend.
Okay. So the takeaway is there's already large employers downtown. They're already here. They're looking around. We're ready for them, and keep it coming.
Keep it coming.
Fantastic. Good. Chris Brochure, leading into this, we talked a lot about the redevelopment existing product. Your company's in charge of building brand new product out at Beltline and Knapp at Knapp's Crossing. Do you see that as one of the final retail corridors with new construction happening in West Michigan, or are there other corridors that are going to pop up on the horizon?
Well, what you're seeing at Knapp Crossing right now is a multitude of small multi-tenanted buildings and freestanding restaurants. There's not a lot of major retailers. Myers is one of the few who are out there building new stores in a very controlled manner. Target, Kohl's, a lot of the major retailers just aren't expanding that like they were 10 or 15 years ago. So I don't say forever that you're not going to see a major retail thoroughfare, but the type of retail that you're going to be seeing built is a lot different than what you saw 10 or 15 years ago.
Sure. So
I think the Beltline is it's an area that has a tremendous amount of high income, higher end homes, and that's what's attracting those type of retailers that we're putting in at Knapp Crossing. I don't know where another area would be like. I think the last two areas that you had locally here was Alpine Road, which got started in the mid '80s with the Green Ridge Country Club, and Rivertown Crossing.
Sure.
But I don't know where anytime in the near future anything like that's going to pop up.
Understandable. Paul, baby boomers have had a huge effect on our economy, our real estate. How are the millennials also going to have an effect?
Well, I mean, certainly we're having that transition. We've been talking about the millennials here. And we're seeing, we're losing a ton of baby boomers every day out of the workforce, and they're being replaced by millennials. We're not quite sure where they're going to perfectly land. They're still pretty young, and people who are less than 35 years old have always liked to live close to the bar, close to where they work, and have low transportation needs. What we've seen over the last 2 years is a lot of household formation. And that household formation starts to ask the question, do you still want to live in a high-rise with 2 dogs and a kid? Or the reverse. And that change might cause some issues. But where we're at right now is it's changing the workforce, making the products that we're doing in the workforce more open, more collaborative. And right now, we're pushing ourselves towards the center city, because not only does the millennials want that, but so do the baby boomers. They're downsizing, they're getting out of their houses, and they don't want to have 2 cars. So coming downtown lets them do that.
And I've heard there are more millennials in population than baby boomers.
Yes.
Okay, interesting. Mitch, institutional investors are an important source of funding for commercial real estate. How's the market validity over the past 6 months negatively impacted the CMBS market?
Well, we're beginning to see that risk aversion begin to price into the market. We've got fundamentally a pretty healthy economy, but you've seen the stock market down roughly about 10% over the first 3-4 weeks of the year. Worst start that we've had in over 60 years. And what you're seeing out there is not only the equity market selling off, but you're also seeing high yield bonds sell off. So another risk market, feeling the pain of risk aversion beginning to spread. Importantly, investment grade bonds are beginning to leak out, even those that don't have any energy exposure. And what concerns us at Fifth Third Asset Management is when we begin to see the CMBS market, which we've always viewed as very, very high quality core portfolio holding for us. Those spreads on 10-year super seniors, AAA securities that last October would be trading about 80 basis points off of a 10-year treasury. They're out to about 150 basis points off.
Okay.
So that risk aversion is spreading. It hits the most volatile portions of the market first, but it's spreading into some of the things you would perceive as being safer. So that's a trend we're watching very closely.
Okay. Back to Chris Brochure and Kevin, the development climate around the state, is it similar East Coast, West Coast in terms of incentives and the process for getting projects approved? Or are there differences across the state?
Actually, there aren't a lot of great differences between the east side and the west side. We haven't done any ground-up development on the west side per se. The closest we've gotten to that is Lansing. But there hasn't, it's more on a community-by-community basis. Even when you look at sort of southeast Michigan, we can go from neighborhood to neighborhood and be vastly different in our ability to get through the process quickly, how we're welcomed, and how the site planning issues go along. Even in communities where we've had developments and we have a history, the climates have changed, the city hall has changed, and it's become more difficult. On the incentive side, it's a little hard to forecast only because there's been a lot of turnover in the MEDC. That's been a political football over the years, and it's gone back and forth, back and forth. And if there's any consistency in the process, it's kind of that it's inconsistent. We've got one project that we've gone to the state for some incentives and help on, and in going through the process and learning about other places where money has been placed, you look at these community funds that are for underdeveloped communities, et cetera, and the funds end up going to communities that already have development going on, and you kind of scratch your head. So it's a little hard to forecast, but east side, west side, there isn't much difference, and we'd love to do some more over here on the west side.
I feel that it's really a community by community basis on the approval process. I find that in older communities that are lagging behind are more aggressive, and that goes right into the incentive programs. The biggest incentives that are used are brownfields, TIFs, and we're very involved in the city of Detroit in doing a number of redevelopments, demolitions. We just completed a project that opened up last June in Detroit that featured a Myers. There was a 1.5 million square foot former Detroit public school on the property. We demolished. We put the whole deal together. There was MMDEC mega credits available and brownfields, and it was very easy process to get through because everybody really wanted to see this hulk of a building come down and redeveloped. So it really depends on the community.
Okay. Back with Chris Brochure again, Kurt and Kevin, or Chris Larson, sorry. Is the Detroit Renaissance sustainable, and what's going to accelerate it, or what could possibly derail it?
Well, what could possibly derail it is when you start to remove any of the distortion effect that is really helping to prop up Detroit right now. I mean, the scale by which either government or philanthropy participates in the renaissance of of Detroit is something that it's almost incomprehensible even in Grand Rapids. And when you think about removing that subsidy, I guess the question is, have they been able to build to a level of sustainability? And I think that that's going to be the real reveal in Detroit. And just to add one more thing to the previous question, I think Kevin was hitting on something important, particularly in Lansing and the perspective of what's happening in Grand Rapids. Too often I find that Grand Rapids becomes almost penalized for doing well relative to other cities in the state. And as a career economic developer, what I can tell you is that dead grass does not grow, right? You water the green spots, and where we're creating jobs, where we're able to perform in the state, right now it's West Michigan and Grand Rapids, we should really be telling our story better in Lansing to make sure that we're able to bring home more of that state contribution. And I understand that it's highly political, but it is working here, and we need to continue to emphasize what's working.
The Lormac Stern is extremely involved in the redevelopment of the city of Detroit. We have half a dozen projects going on right there. Our firm is not only involved just in the real estate business, we have other businesses as well. And in the last 5 years, since Mayor Duggan has taken over, well, 2.5 years since he's taken over, but in anticipation of them happening, we bought a marina on the riverfront. We purchased a charter school business and opened up a restaurant in the CBD. We are, I feel that the city of Detroit has a new mayor. The bankruptcy's cleared the decks. I think as long as Mayor Duggan's there, he's doing a great job. He's seeing to it. When I was driving around with him in the city before he got elected, the number one goal that I've been saying it for years and years and years, the blight has got to go. And he told me that, he says, well, we can't do it all at once. He's going to do whatever he can to clean the city up. And he's kept his word to the citizens of the city of Detroit. And it's remarkable what I used to see 5 years ago compared to what's there today. He's focusing in on certain neighborhoods. He's doing a lot of the demolition in the neighborhoods. As you just said, you have to water the green grass, and that's exactly what he's doing. He's taking care of the really good areas and making sure they stay stable. So I think that as long as we have good leadership in the city of Detroit, it's the renaissance, so to speak, will continue.
And I would completely agree. My answer was going to be just stable and effective government is going to be what's going to sustain it and what could potentially derail it if you don't have it. I'd go beyond the city. I'd say the county as well. The county, Wayne County, has had some incredible difficulties and had a lot of the past political issues that the city has had. The new county executive and the new city mayor are doing a great job. If we can continue to do that, I mean, there's a lot of people that deserve a lot of credit. You know, a lot of the automotive companies stepped up. GM relocating downtown, that's all helped. Danny Gilbert probably deserves the lion's share of the credit. And thank God he's probably not going to run out of money. He won't run out of commitment. It's whether people follow him behind him, and he's pulling other companies in and fostering an environment. Now, if we can just get really to sustain it, you got to become a 24/7 city, and that's the schools, the police, the fire department, everything that's been lacking in the city. But they're making headway, and if they can do that, it's going to happen.
An interesting point is on the Quicken Loans Dan Gilbert front. Out of the 85 plus buildings that he's acquired in the central business district and around downtown Detroit, very few of them have been done with governmental incentives. Okay. Very important.
That's fantastic. Good for him. Mitch, how does the stock market and oil prices, how is that affecting how the investors are moving around?
I think the volatility that you're seeing out there, it's interesting in a way. If you've heard the press talk about the declines in the stock market, and could that create a negative wealth effect? Would businesses stop spending and investing? Would consumers stop spending? That's one of the real risks that we really haven't talked about, but the market could do that. What's interesting is you've got declining oil prices coming down, and that's hitting companies that are in the energy sector, in the S&P, hard, and so it's forcing down their share prices. But the U.S. economy, and what's always interesting to me, the U.S. economy is actually only about 1% dependent on energy production. And I think we forget that the consumer, talking to a lot about what Paul was pointing out earlier, the consumer gets a big windfall from this decline in oil prices, decline in gas prices. And the fact that you're able to have this volatility in the marketplace, which should be depressing consumer confidence levels, the numbers we saw 2 days ago, actually showed consumer confidence up. And I think you can really tie that back to that benefit of lower gasoline prices. It really affects every consumer out there. So a lot of volatility out there, but just because lower oil prices are bad for the S&P and cause the stock market to go down, don't necessarily assume it's bad for the economy.
Okay, great. Paul, you touched on during your presentation the auto industry, how it's kind of reached its peak in production and manufacturing and leveled off, and it's going to head back down just a little bit, nothing to make us too worried. I'm assuming it's going to slow down to a healthy spot for our economy, and hopefully. How else can Michigan rebrand ourselves outside the auto industry?
Well, that's the trick. I mean, we have so much resources devoted to automotive because it's such a high-value industry. It kicks in so much wealth into Michigan that once it starts rolling, it's really hard to redeploy that stuff to other industries and other places. But what we have done is we've started to really rebrand Michigan as a spot where we are seeing a lot of willingness to go out and take some entrepreneurial risks. We're seeing it here in Grand Rapids, we're seeing it in Detroit, and we're starting to see the capital follow it. We're starting to see professionally managed capital wealth come in. The second place that we can deal with is we make the place great for millennials. Mm-hmm. So we're back to the same old story, but what Michigan does have is your cities are really close to being at places where you can be outside playing, you can be downtown watching a concert, you can be at your job, and you can do all that within a 1 hour circle of your house. And if you look in other places of the world, like California, like Denver, the places that they're locating have that as well.
Sure. And how do the Great Lakes factor into our rebranding?
We have 20 to 25% of the fresh water, depending on which measure you use in the world. We need to leverage that. We have with beer, so that's useful. It makes my Saturdays better. But there's lots of other industries that are water dependent, and there's lots of recreation that's water dependent. And most of the rest of the world still thinks most of the rest of the United States still thinks of the Great Lakes as the little fishing pond that they go to down the road. So to the extent that we can rebrand that for recreation, and the extent that we remind industries that they're not going to have the droughts that they have in California, the more they're going to want to be here.
Sure. Fantastic. Kurt, I'd like you to touch on this as well as Kevin and Chris Brochure. How are construction costs affecting development, working with new tenants, as well as are the costs similar across the state? And how are the trades finding their employment? Are the trades?
Well, costs are coming up. There's no secret about that. The trades are busier, and supply and demand is having its effect. I think what you end up with is, and I was really happy to hear what Paul was saying about middle incomes, because what we have right now is a gap between what a project costs and what it can produce in income in terms of either residential rents or office rents. And that's where, when these guys were talking about the brownfield incentives or the MEDC incentives, are really necessary to bridge that gap right now. Now, if Paul's right and some of these people can afford a little bit more rent, it doesn't have to be a lot more, but a little bit, we can then produce projects that don't need those incentives, and that would make life a lot easier for people like me, for one thing, but it would be a good thing across the board. And there's a couple other little just random thoughts I had as people were talking, but anybody that was at the Econ Club when Mayor Duggan from Detroit was here had to come away with a great degree of optimism. I mean, he's really... And I really think that that was a really neat presentation, but it was also, gets you to the point of, municipalities needing to prioritize things and decide, what are we going to support and what aren't we going to support? Because everybody's got an idea and everybody thinks it's a great idea, right? And then, so I think I really think that we'd like to be able to wean ourselves off those incentives and maybe make them more available to places like Flint and Saginaw that probably need them more than we do. But Chris makes a great point as well, in the sense that, how do you make those decisions? And I think the MEDC is starting to come around to the idea that maybe the incentives are still there for everybody, but the terms are a little different. And I think you've got to start making those differentiations so that things make sense across the board.
Just 4 years ago, it cost us about $50 a square foot to build a warm dark shell. Today, it's costing us $85 a square foot.
Wow. You need a different contractor, I think.
It's like that all over the state of Michigan. And everybody always says Michigan is so bad because of the unions. They've never been to Chicago. We're redeveloping a 1 million square foot mall in Chicago, and there, so anybody that says Michigan's bad, they got to go there. The costs there are about $100 a square foot, and everything is union. Can't get away from it. What I said earlier about the number of bankruptcies causing a lot of vacant boxes that were backfilled by retailers like Bed Bath & Beyond and TJ Maxx and so on and so forth. These retailers got used to very low rentals. And I can give you an example. Recently we had a deal where we had a 100,000 square foot former Kmart that we're redeveloping. And it's going to cost almost as much to redevelop that site. We can save on the site work, but it's going to cost, you got to put on new HVAC, new roof, tear down parts of the building. And I call up a retailer, I'm not going to mention any names, but he says, oh yeah, we'll pay $10 a square foot, like he's doing me a favor. I said, it's going to cost me $12.50 to break even. And so it is definitely a factor, there's no question about it, and it's kind of like a governor on the acceleration.
Yep. Yeah, it's the same story. Roughly speaking, in the last 10 years, our construction costs have gone up about $10 a foot. And you can't save off retail, which is why we do a lot of redevelopment. But when we do new construction, Kurt mentioned some tenants can pay a little bit more and therefore afford the new construction. That's true. Those are build-to-suit tenants, which we typically don't cater to. On a spec side, which is what we're more known for, it makes it really difficult because what you need are rate and term. And as Chris was saying with some of his retail tenants, our tenants need to recalibrate their setting as to what is reasonable. And it's not that anybody's trying to gouge them or anything, it's just we need to make a reasonable return or you can't get the kind of product you need to keep the market fluid. And so, especially in Grand Rapids, the rates are probably off at least $1. I mean, to get a new industrial building, and these are just broad sweeping numbers, and do a spec development, you're talking high fours, triple net as a lease rate, and you really need, 5 years. 3 years in Grand Rapids, been our experience, is long-term, and a lot of tenants have gotten used to 1 or 2 year deals at times. And that's fine for the tenants, but it's not really good for the overall health of the market. If everybody can kind of work together and recalibrate, you get the product you need, tenants get to move around, everybody kind of, all boats rise with the tide. So it's really for us, rate and term.
If I could throw one other thing in, it's kind of, you think about the interconnectedness of everything. It's kind of interesting. In multifamily projects now, we're getting pressure to create rooms for all the Amazon packages. So
really? Okay.
Tells you a little bit about what's going on in retail.
Well, Paul, and you're hearing this where the materials for the contractor is going up, so he's charging more to build the product because they're paying their employees more. The contractor's paying their employees more. The landlord has to pay more for his building and then lease it to his tenant for more money, and the tenant's paying their employees more money. There's a lot of wage increases out there, huh?
Yeah, I mean, that's, for an economist, that's the beginning of an end. It's what everybody wants. They want that increase in wages, but it's the first sign that we're near the next recession. Right. And because this will eat into corporate profits, it will change the types of deals that can be made, and it slows things down.
Sure. So hopefully it is a healthy movement up, not too drastic.
Yeah, we don't have to worry about it this year, I don't think.
Okay, good. We'll just stop you right there. We don't worry about it this year. Mayor Bliss, Chris Larson, how's the CBD positioned to handle its current and its future parking, as well as just traffic flow around the CBD?
Parking. Of course, we had to talk about parking.
And you can go first.
Yeah. Parking is a dynamic topic, and it seems to elicit highly visceral emotions when we discuss it. Yet it's interesting when we look at the parking system in the downtown. It's really several independent systems. You've got privately owned parking, and then you've got publicly owned parking. And generally, we have conversations about the publicly owned portion of the system, which is about 40 to 50% of the total supply. And we've got a pricing structure that is somewhat illogical. And so we have basically incentivized people to park close to where they work, which of course is every employer's dream. And we're not creating an incentive for people to park further outside. And I do think that there needs to be a recalibration of the methodology for the system, because we have, right now within the existing supply, we have 1,000 spaces that are underutilized or unleased, which doesn't even talk about occupancy. At peak occupancy, we're looking at about 68% occupancy. And so there's a lot of room within the system to be able to accommodate additional users. It's really about creating a price structure that helps to encourage behavior that creates, I think, a better management system.
Okay.
Well, and I'll just add, this will always be an important issue that we're looking at and we're assessing, and it will forever evolve. I mean, the world is going to look very different 10 years from now when we're looking at transportation. I mean, for me, I want a city where we have multiple opportunities for people to get around and get around safely. So we need a robust public transit system that is aligned with worker needs, and we need safe streets for people to bike on and for pedestrians, and we need places for people to park. They may need to walk 3 or 4 blocks to get to where they need to be, but so it needs to be balanced. The city is working really closely with DGRI. The GR Forward plan has a lot of goals around mobility. We're looking at our parking department and adding in a lot of expertise around mobility, and how do we have this more holistic view of mobility in the city. And you look at great cities all throughout this country, and they have multiple opportunities for people to get around in a safe way. So we always have to be thinking about that. We have to be thinking about the next generation and how they get around, and fewer of them have cars, and so that always has to be a discussion.
Okay.
If I could just add, I guess 2 more thoughts to that is one, and I mentioned Spectrum's move earlier, and one of the really key decision points there was parking. And it wasn't necessarily, we need to have X number of spaces, which is the traditional conversation. We were able to work with them to adopt a parking cash-out plan. So moving from parking as an entitlement to parking as a benefit, and allowing the individual employee to make a choice about whether or not they receive the space or the cash benefit. And they were able to basically offset their need by about 25%. And we've seen that trend nationally, about just enabling people to make the choice that best benefits their own lifestyle, rather than making a presumption about what they need or what the business needs for success. And the second thing is, and this is going to sound a little bit futurist, but I really am concerned about future public investments in parking, where we are designing it solely as a parking structure for today, particularly thinking about the changes in mobility, the investments that are being made by very, very large, well-known companies like Ford and Uber and Google in driverless technologies, and thinking about how we design structures in the future, hoping that we can plan for the adaptation of those structures over time, and plan for them to be able to be repurposed as our parking supply needs diminish. Because those become long-term public obligations, in some cases 25 or 30-year bonds, and wanting to make sure that we have the revenues of the future and they're not underwater in those types of investments.
Yeah, that's a great point.
Okay. Paul, I'd like you to touch on, with Spectrum, such a monster presence near our CBD and in our area, as well as the Van Andel Institute and such. What does the medical industry bring to the West Michigan economy, the Grand Rapids economy, from a wealth standpoint or employment?
Well, from an economic point of view, they provide a couple of things for us that that are very useful, looking at it as an economist. First of all, they're providing an opportunity for someone to be treated here. If you went back 20 years ago, you needed certain procedures done. You went to the other side of the state, you went to Cleveland, you can now get pretty decent health care here without doing that. In many cases better. But in the other thing that it does is it stabilizes the economy in that it's a consistent, it creates a nice baseline. We're heavily dependent in this area on cyclical industries, ones that go up and down. So having an anchor of a very large industry like Spectrum here to anchor a baseline is extremely important if we want to do well in the next downturn.
Sure. Well, fantastic. Well, everybody, that brings us to a conclusion to get us out of here by 10 o'clock as promised. We appreciate everybody coming to be a part of this event. It's not possible without our panelists, our speakers, of course, our sponsors, all of you in the crowd that stopped by. We all hope that you have some takeaways from this. One of my takeaways is what an awesome state we live in, what an awesome community we live in, and how many great people we have on a daily basis that are continuing to drive all these communities forward to benefit generations to come. You're going to be receiving a survey via email. It's very important to us that you do take the time to fill that out. We do read all of them. We would love recommendations for any other speakers or panelists you would like to see next year. There's a few logistical things. If you've parked in a DeVos ramp or the government ramp, your name tag has a validation ticket in it. If it's missing or you just want to steal a couple extra, you can go to the registration table and they'll happily give you more. Also, it's very important, you are not allowed to leave here and take a right and go through the auto show. They will arrest you and make a huge example out of you. I know there's some naughty people out there in the crowd. I've already seen them this morning. Don't do it. You'll get in a lot of trouble. You have to go out of here and you have to take a left. We appreciate you following the rules this one time. But again, thanks again for coming. We love doing this event. We love having everybody's involvement. We love seeing the faces in the crowd, and we will see you next year. Thank you.